Hopefully everyone can hear me. Welcome to the lunchtime webinar where we're going to cover off PAYE and national insurance. Just a bit of housekeeping to start with. What we're going to do is we're going to run some polls as we go through. So if you wouldn't mind going to slido.com or scanning the QR code, you'll be able to participate in those polls as we go through the slides. Everyone will be on mute as we go through. So if you do have any questions as we're running through, please just put them into the chat box, and then we'll come to those either at the end if we haven't covered them as part of the presentation, or we'll pick them up as we go if we can. So my name's James Alesbury. I'm a director at HWB. One of my hats is to oversee the Payroll Bureau. I've been with the company for coming up to 15 years now, and actually been part of payroll in some shape or form for nearly 26 years, sad to say. So been here in the sector for quite some time. So the first poll we're going to look at is just to get a flavour of how you're actually running your payroll at the moment. So if you wouldn't mind going in and putting whether you do your payroll currently either in-house or you do outsource. And I'll just give you a minute to fill that in. Right, so it looks like the majority of people are doing it in-house. And we do have 33%, or no, it's changing by the minute. So we now got 40% that outsource. So quite a good mix, actually. And it is quite different when you're running payroll in-house to outsourcing. Certainly, the process is very different. And we find a lot of people that actually do it in-house. You tend to say you've got a financial controller doing it in-house. They do have to be a jack of all trades ultimately and know everything about everything. So it's very difficult to know everything about payroll when you're not a specialist within that area. But it's good to have that split. So the agenda for today, what we're going to run through is we're going to look at the consequences of the reduced secondary earnings threshold, the changes in employment allowance. We're going to do a bit of a recap on auto-enrolment and re-enrolment, touch on salary sacrifice pensions, which will be quite topical at the moment. And then really briefly, we're going to cover the national insurance for apprentices and national minimum wage and living wage. And the next slide we're going to look at is another poll on how confident you are with current payroll legislation. So this will give us a bit of an idea on where people are at the moment. And hopefully we'll be able to improve on these results as we go through. Give it a minute while they all come through. So we've got a lot of people that are very confident. Maybe we need to swap jobs. But yeah, we've got the 60% being fairly confident. So that's good. It's good that people are aware of what's going on. I know there was quite a lot of changes back in April 25, and obviously we're going to cover those today. So it's still changing, but yeah, we'll move on from there. So the first thing we want to talk about is the secondary earnings threshold. So this is the amount that an employee can be paid before they incur any employer national insurance liability. And in April 25, it changed. So it went from £9,100 a year to £5,000 a year. The next point on here looks a bit misplaced really with it, as I'm talking about directors, but that's the whole reason we're talking about the secondary earnings threshold. So directors are paid cumulatively, which means that the liability is calculated on a year-to-date basis for national insurance. Now, the change in the secondary earnings threshold really made a difference to tax planning and how much directors take through the payroll. Historically, a director would have been paid up to the lower earnings limit, so they got all of their statutory benefits, so SMP, statutory sick pay, etc. But most importantly, they would have a qualifying year for state pension. Now, by being paid the lower earnings limit, they wouldn't incur any employer's national insurance. Now, because the secondary earnings threshold now of £5,000 is less than the lower earnings limit, which is now 6,500, they would still incur if they get paid the lower earnings limit, they will incur a national insurance liability. But what they don't want to do is be paid up to the secondary earnings threshold now, because they would miss out on the state pension qualifying year. So that's quite a big thing to consider when you're looking at directors' salaries and how much to pay them on an annual basis. The employment allowance, the changes in employment allowance, so this increased from £5,000 to £10,500 from April 25. Now, the eligibility criteria around single director payrolls not being entitled to it, government money, so contracts over 50% of the money would exclude you as well, and connected businesses, all those rules, they remain in place. Now, the one thing that did change is the previous year's liability for secondary national insurance, so the employer's liability in the previous tax year. Now, where that exceeded £100,000, you weren't entitled to claim the employment allowance. Now that's been removed, so you can now claim the employment allowance. Now, all of the changes for the employment allowance was to offset really the increase in national insurance from 13.8% to 15% for employers. The idea behind this is for the smaller businesses, they can claim an extra £5,500, which would hopefully offset that increase in liability. So it is just worth checking if you weren't entitled to it in the previous year, and the reason you weren't entitled to it in the previous year was because of that £100,000 limit. That would no longer be stopping you from claiming that. My last point on this slide is very much a question. It's a potential solution. I'm caveating this in the fact that if you are a single director business, it may be worth looking at taking someone on the payroll and paying them over the secondary earnings threshold, to then you would be entitled to claim that employment allowance. Now, there are a lot of other considerations to think about as well, though. The first one that pops to my mind is going to be the pensions and auto-enrolment. So as soon as you employ someone, it might be you then have to then start doing auto-enrolment and registering with the pension regulator, etc. So there's additional costs there. You've got the cost of actually paying that person. You've got any HR admin to consider as well, all those sort of things. But it is worth looking at if you are a single director business as to whether it's worth to make that claim for the employment allowance of £10,500. So auto-enrolment has been around now for 13 years. And one thing we do see is people are still not getting it quite right. So we've seen a lot of businesses we go into, and the processes are missing, the steps that are missing within. So I just wanted to do a bit of a recap on the correct way of actually administering auto-enrolment. So this is something that has to be looked at every payday. We see a lot of people that what they do is they say, we've already done our assessment of people before they even run a payroll. And you can't do that purely because it's all based on age and earnings. And those earnings are as part of the payroll and have to be processed. And then what you would do is categorise the workforce, which I'll come back to in a second. Then you've got statutory notices. So statutory notices have to be sent to the employees when they start or are automatically enrolled into a pension scheme, telling them what auto-enrolment is and how it affects them. And also whether you're using postponement. So this is where you can defer in enrolling an employee for up to 3 months. And if you do postpone them, you tell them that you postpone them in writing, and then you write them again once you actually enrol them, or you will not enrol them because they're no longer eligible. This isn't the letter that you get from the pension provider to say that they're in a scheme. So that's one of the big mistakes that we see, is that they say, well, the pension provider is sending the letters out. It's not always the statutory notices. Some pension providers do actually do the statutory notice, the likes of Royal London, the bigger companies. The smaller ones won't. It will just be a welcome letter from the pension provider. So it's just making sure that you're doing your statutory notices and giving them, the pension regulator define the wording that you include within this. And they actually have templates as well that you can take it from, and a lot of payroll software actually has it built into now as well. But it's making sure that that's being covered. And then circling back to the age and earnings, the workforce assessments. So these are done every payroll, and you have to have evidence that these are done, and you're categorizing your workforce. So you're putting them into 3 brackets: eligible job holders, non-eligible job holders, and entitled workers. And you have to have evidence that you've done that every time you run your payroll. If the employee is an eligible job holder, that's when they have to be automatically enrolled. So as I've said in the slide, the action's based upon the category of worker themselves. Non-eligible job holders, they can opt in, and entitled workers, they don't actually need to be enrolled. And even if you put them in, they want to be enrolled, they don't have to be within a qualifying pension scheme. So there's different rules for the entitled workers, but I wasn't planning to go into that much detail on the categories at this point. One big thing, or one of the mistakes that we see as well, is that eligible employees must achieve what's called active membership of a pension scheme. What this means is that if I started at a job and I was eligible based on the age and earnings, and I've been run through a payroll and I've said, no, I don't want to go into a pension scheme, and you don't put me in, you're not following the auto-enrolment regulations. So that you have to have set them up within a pension scheme. It doesn't mean you have to have taken contributions, but it does mean that they need to have been active within that pension. There's practical issues around separating those two out, but ultimately what I would suggest and recommend is that people are put into the pension, deductions taken, and then if they don't want to be in the pension scheme, they can opt out in the normal way and receive the refund of contributions, as long as they opt out within what's called the opt-out window, which is 1 month from becoming an active member of that pension scheme. Another point is that you can't be seen to be encouraging the opt-outs. So you're not allowed to what I suggest is we don't even speak to the employees about opting out. I mean, they'll have all the information within the statutory notices. You're allowed to answer any questions in terms of where the opt-out form can be found or how they opt out of the scheme. But you can't be seen to be encouraging the employee to opt out of the pension, as if they see that you're trying to save money for the business. And then finally, in terms of the tiers or the sets, there's 4 different tiers and sets within auto-enrolment regulations. So this is how you build your pension scheme itself. And that's not necessarily the key point, but I just want to explain what I mean by this, is that you've got the pensionable element of the salary. So that could be basic salary. It could be basic salary with an 85% pool, which means total earnings, 85% that has to be pensionable. And then you have total NI will pay, and then you have qualifying earnings. Now, auto-enrolment was based around qualifying earnings. Now, this is where there's a lower and an upper cap, and the pensionable element is the amount in between. If you use anything outside of qualifying earnings, you have to do what's called pension certification. Again, something that we see a lot of people are missing. So this pension certification is a paper exercise. Ultimately, the pension regulators say that you have to comply and say that, confirm that your pension scheme meets the auto-enrolment regulations. A lot of the bigger providers, again, Royal London, Scottish Widow, etc., they will give you a form, you sign it and put it on record. The smaller pension schemes, the master trusts of this world, they won't be providing that to you. So it's making sure that if you're using anything apart from qualifying earnings, that you do have a pension certificate on file. They last up to 18 months, so you do have to redo them. And the pension regulator can ask to see that. So we do see a lot of companies that don't have that in place. So it's just making sure and check that you've got that on file for your company. And then we're looking at re-enrolment. So this happens every 3 years. As an employer, you get to choose your re-enrolment date. You get a date 3 years this is where it gets confusing. So you get a date 3 years from the 3-year anniversary of your previous re-enrolment or staging, i.e. when auto-enrolment started for you as a business. And then you get to choose a date 3 months either side of that 3-year anniversary date. If you're running a monthly payroll, ultimately it doesn't really matter on the date in which it falls within the month. So it will just be those 6 months. So for our clients, for instance, we would be asking them to choose a re-enrolment date, and that's the date that you would run your re-enrolment process. Now, the re-enrolment process is identifying all of your eligible job holders, removing the ones that are currently in the pension scheme, and then remove the ones that have opted out in the previous 12 months. The remaining eligible job holders would be the ones that you would then put back into the pension scheme. And a reminder is eligible job holder is someone that is between 22 and state pension age, earning over, in this case, if it's monthly, £833 in that month. So they would all go back into the pension scheme, no matter of preference. So if they don't want to go back in, they keep opting out every 3 years. To comply with auto enrolment, you still have to keep putting them back in. And then you write to them to say, we've run re-enrolment, eligible, and click back into the scheme. These are the details around opting out. And again, the pension regulator provides statutory wording around what you would have to tell your employees. Then there's a redeclaration of compliance as well. So when you originally staged your business, it would have done a declaration of compliance, and that was due 5 months after staging. The redeclaration of compliance, again, is the same. It has to be sent through to the pension regulator within 5 months of your 3-year anniversary date. So ultimately, every 3 years, you're moving your re-enrolment date because it will depend on when you actually chose to do it in the previous re-enrolment. But yeah, you get 5 months to do your 3-year anniversary. You get 5 months to send your redeclaration of compliance to the pension regulator. And ultimately, all that is, it's saying details around the business, contact details, etc., and then saying how you complied with your re-enrolment and who you've put back in, not on a name basis, just on numbers, but how many people have gone back into that pension scheme. So just another quick poll. How confident are you covering your auto-enrolment duties? So based on what I've just run through, how many of you think that you've covered all of those bases? Give you a minute to run through. That's a lot of yeses, which is good. Oh no, the no's have just gone up. Okay, so we've got 67% with yes and 33% with no. And to be honest with you, for the no's, I wouldn't worry. I think there's a lot of people in the same boat. It is an area that we just haven't got right in the majority of businesses, I think. So we found when people started auto enrolment, a lot of them were going towards IFAs to solve the problem, and ultimately because it is based on payroll records, it's just not possible to deal with it in that way. So yeah, but certainly good that 67% are got that. So we just want to do a bit on salary sacrifice pensions, and this is quite topical purely because of the changes in national insurance. So because employer national insurance has obviously gone up from 13.8 to 15%, salary sacrifice pensions is a way that you could reduce your employer national insurance liability. But it also maximises the pension pot for the employees. We can't say it's always the right thing for employees. We're not allowed to say that, but it's certainly a good way to maximise the amount that's going into that pension. It might not be for everyone, but it certainly it gets the national insurance saving. What it also does is if you've got quite a lot of high earners in your business, they could potentially be missing out on the higher rate relief for the pension, the higher rate pension relief if they're in a net of basic rate tax pension scheme, because that has to be done through a claim to HMRC separately. So if you're using salary sacrifice, then you wouldn't have to do that. You could, it would claim it all the way through the payroll, so you wouldn't have that issue. And then you've got to consider the HR admin as well. So when you use salary sacrifice, it's a change in terms and conditions of employment. Now, what that means is that you have your contract of employment, it states how much you're paid. If you use salary sacrifice pension, we have to have a letter confirming that this is your salary pre-salary sacrifice. This is the amount that you are sacrificing, and this is your new salary in effect. Because what you're doing is you're giving up the right to that salary in exchange for an increased employer pension contribution. So there's no such thing as an employee contribution under salary sacrifice, because the employer is paying it on your behalf, but you are giving up the right to your salary in exchange for that. There's also national minimum wage and living wage considerations as well when we're looking at the HR side of things, because if you're giving up your salary, you can't be paid less than the national minimum or living wage. So it's making sure that when you get to your new salary, it's still higher than the equivalent of the national minimum or living wage. So it's just a quick check there when people are opting into that salary sacrifice pension scheme. Another key point is that when you are doing a salary sacrifice pension, you have to offer an alternative. So people are entitled to opt out salary sacrifice, but continue into a pension scheme. So having a net basic rate tax scheme available running alongside is the best thing to do ultimately. And actually, most pension providers will just ask you, okay, for a salary sacrifice pension scheme, tell me what all the contributions are as an employer, and for a net basic rate tax, tell me what the employees and employers is. So splitting it out separately, because what they'll then do is make a claim on the employee's contribution to HMRC to get that tax relief. So very briefly, just want to touch on national insurance for apprentices. So we've got, there's no employer national insurance due on earnings up to, I'll put here, £4,189 per month. So this is the apprenticeship upper secondary threshold. Ultimately, it's the same as the upper earnings limit at the moment. And it just means that if you have someone that's in a recognised apprenticeship scheme, making sure, that they're under the age of 25, making sure that that you are using the correct NI rate within your payroll and not paying any employer's national insurance up to that limit. Now you can make a claim if you haven't done it correctly, and you can go back for complete tax years, and we've put them there on the slide. So it's just making sure that if you have got apprentices in your company, that you are benefiting from that relief, that employer's NI relief. And lastly, the national minimum wage and living wage. So just to recap on what they are at the moment, really. So it increased from April this year. It's going up quite significantly at the moment. So and obviously we had the age change as well recently. So we've got 21 years and over as £12.21 per hour. 18 to 20 at £10 per hour, and under 18s at £7.55. And then we've got the apprenticeship rate as well, which is for the under 19s or in the first year of the apprenticeship itself. So I hadn't planned to go into any more detail on that, apart from just give a bit of a reminder on the rates themselves. And for people that aren't aware, what we offer at HWB, a shameless plug on what we can do for you. So our payroll team do have advisory services. We also offer consultancy for the strategic side of things, and can be involved in project support when things are changing within a business. We also have the fully outsourced payroll and auto-enrolment solution. So this is taking payroll from input all the way through to actually submitting contributions to your pension provider, providing letters and things like that, statutory notices, covering ultimately everything. We also offer a service of the redeclaration of compliances and re-enrolment, etc. as well. So we have that. And we also do a PAYE health check. This has been quite a good one in the past. So ultimately what we would do is we come into a business and we'd look at your current processes, see exactly how you're doing everything, and then we would report back on our recommendations on tightening up processes ultimately and making sure that you're fully compliant. And we can do that for the payroll side of things, but we can also do that for auto enrolment as well. So we look at everything from start to finish, and like I say, we will give you a report on how that can be improved. If anyone is interested in any services that HWB offer, then by all means, you can drop me an email. I'm happy to have a chat around that. And then we're going into the Q&A session. I see we've got a question here from Joe. Is there an advantage for employees? Okay, so it depends on, this is looking at advantages of the salary sacrifice pensions for employees. So if you were in a net of basic rate tax pension scheme, what happens is it's taken net ultimately. So it takes out a net pay, you send that to the pension provider, and then they claim 20% tax relief and top up the pension pot. What you're missing out on at that point is the employee's national insurance, because they've already paid that. So if you do a salary sacrifice pension, it comes out before tax and before national insurance. So that's where your difference is. And therefore it makes it worthwhile. Obviously, if you don't pay any tax or national insurance, your earnings aren't high enough, it wouldn't make sense to do it. But yeah, certainly for someone that's earning above the primary earnings threshold and is paying national insurance and incurring tax liability, salary sacrifice pensions would make it the contribution higher into the pension pot. So I don't think we've actually got any other questions from anyone. I'm looking at my colleague. Yeah, we had a question about HWB undertaking auto enrolment checks for businesses. As I said earlier, yes, we do offer that as it's actually part of a health check, but we could look at that in isolation if that was something that someone wanted us to look at, and just look at it from take a step back and step by step and go through it. That wouldn't be an issue at all. I think it's certainly worth a conversation if anyone was concerned about that, and we could see currently what you're doing, and then is it worth us actually looking at that, or whether it's just a simple answer for you. So if anyone does want to consider that, then please, by all means, get in touch with me. So I think the last slide on there is my contact details. So like I say, if anyone has any questions that they want to follow up with, as soon as there's another question coming in. So if anyone's got any questions, then by all means, let me know, drop me an email. But otherwise, thank you everyone for attending. And yeah, I'll hopefully speak to you soon.